The markets are sending mixed messages, now more than ever. How are we supposed to know what to do? Depending on where we get our news, we may be told the Fed's about to cut rates, or maybe not. The stock market's making new highs. It's about to crash. It's time to buy a house. There's no homes for sale. We're going to break down today's data and give you just the facts. Exactly how hot are today's inflation numbers? Are retail sales really that bad? What can the Fed possibly do at this point? Just consider today's retail sales report. Inflation dents rate cut hopes as retail sales slump, or retail sales rebound in February in a sign of consumer spending resilience. Well, let's have a look at the data. Retail sales are broken down into several categories. Retail trade grew by 0.8% compared to this time last year, certainly one of the lowest readings we've seen. Grocery store sales do not look good. With an annual gain of 0.2%, this matches December's readings and the lowest in several years. Electronics and appliances, following an abysmal 2022 and 23, is now back in positive territory, but only by a little. At a current 1.9%, we would hope for more progress given the sale of appliances is associated with a home builder economy. Non-store retailers, or as we would describe it, simply online shopping. A 6.4% gain in the lowest year over year number, only undercut by the 6.3% reading achieved back in January of 23. This particular component of retail sales is probably the most troubling sign for the real estate market. Building materials and garden equipment, directly correlated to housing, declined 6.1% and has now been in negative territory for a full year. Gas station sales have been weak as well. At a rate of negative 4.5%, this represents a 13th consecutive month below zero. Given the obvious weakness in retail sales, are interest rates too high? Is the Fed about to torpedo the economy? Could the Fed cut rates now? Well, maybe not. And here's why. The PPI, Producer Price Index, a measure of prices on the wholesale level, has been trending lower at least until recently. Today's PPI report of 1.6% shows the highest year-over-year data going back to September of 23. The core PPI, which excludes food and fuel, has also declined steadily over the past few years. At an annual rate of 2% matching last month's figure, this also represents 4-month highs. It's clear that inflation is back on the rise. In fact, we now see a warning. Stock market crash alert. Hot wholesale prices are shocking Wall Street. Can anyone argue with that conclusion? Maybe so. As written here, the inflation rate is falling, but prices are not. With all the mixed messages seemingly now more than ever, how are we supposed to know what to do? As always, the market will ultimately tell us what to do. Here we see the Fed funds futures react to all this news. In red, the probability the Fed will not cut rates in May now sits at 96%. In fact, there's only a 4% chance the Fed will cut rates in May. Given the conflicting messages between rising inflation and weakening economic conditions, the Fed is just not ready to budge. So why are stocks now in seemingly a bad mood? As we discussed in our recent CPI report, inflation is associated with a growing economy. As the current CPI stands at 3.2%, these rising prices indicate business revenues should also rise. But we must see this growth in the numbers. In simpler terms, if we're willing to endure the bitterness of inflation, we should also savor the sweet rewards like robust retail sales. But apparently now that's just not the case. We must now face the gloomy reality of rising prices without the sunny aftermath of a prospering economy. If we must endure rising prices at breakneck speeds, we at least would like to be able to enjoy the ride.